Ladies and gentlemen, good day and welcome to the Bandhan Bank Q2 FY2026 earning conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. I now hand the conference over to Mr. Vikas Mundra, Head of Investor Relations. Thank you, and over to you, sir.
Thank you, Danish. Good evening, everyone, and a very warm welcome to all of you. It's a pleasure to have you with us today as we discuss Bandhan Bank's business and financial performance for the quarter and half-yearly ended September 2025. We apologize for the late and appreciate your time and continued interest in the bank. I also hope you all had a joyous festive season and wish you and your families good health, happiness, and prosperity in the month ahead. In today's call, we will take you through our business performance, key achievements, and challenges during the quarter. Joining us on the call today are Mr. Parthapratim Sengupta, sir, Managing Director and Chief Executive Officer, Mr. Ratan Kumar Kesh, Executive Director and Chief Operating Officer, Mr. Rajendra Kumar Babbar, Executive Director and Chief Business Officer, Mr. Rajiv Mantri, Chief Financial Officer, myself, Vikas Mundra, Head of Investor Relations, and other members of our senior management team. After the management remarks, we will be happy to take your questions and provide any additional clarity on the quarter's performance and our outlook. With that, I would now like to invite our Managing Director and CEO, Mr. Parthapratim Sengupta, sir, to share his thoughts on the bank's performance for the quarter. Over to you, sir.
Thank you, Vikas. Good evening, everyone, and thank you for joining us today. On behalf of Bandhan Bank, I would like to extend a very warm welcome to all participants on our earnings call for the second quarter of financial year 25-26. I hope you and your families had a wonderful and fulfilling Diwali. I wish you continued good health and happiness in the festive season ahead. This quarter's performance reflects a transitional phase for the bank as we continue to realign our portfolio and operating model in response to the changing environment. The recent 75 basis point repo cut in Q1, which we proactively passed on to our customers on the first day of Q2, had a short-term impact on the margins. However, this is part of the adjustment process that will position us well for sustainable growth ahead. As the repricing of deposits takes place over the next few quarters, we expect to see the full benefit of lower funding costs, which will help improve margins and support profitability. Before delving into the quarter's performance, let me begin with a few initiatives we undertook during the quarter to improvise our products and services with innovative solutions and to better serve our customers. We continue to focus on strengthening our granular liability franchise through innovative and targeted offerings. We have successfully launched the Grow CASA Grow Together campaign, an exclusive CASA drive aimed at promoting current and savings account growth across segments. This initiative is gaining traction and is already yielding encouraging results. This reinforces our commitment to building strong, long-term relationships with our customers. We further place emphasis on sourcing new corporate salary accounts by leveraging our revamped salary product offering. This initiative allows us to provide a more seamless and rewarding banking experience to employees of partner companies while expanding our CASA base in a sustainable manner. The bank introduced specialized products for HNI individuals, including the Elite, Elite Plus, and Legacy Savings Accounts. It is designed to meet the unique needs of our HNI customers. These offerings not only enhance our value proposition, but also deepen relationships with this key customer segment. Through this focused initiative, we are confident of driving CASA growth, enhancing customer engagement, and delivering long-term value for all stakeholders. We have made good progress in strengthening our digital and government ecosystem partnerships. I am pleased to share that Bandhan Bank has successfully integrated with the Central Board of Indirect Taxes and Customs for the collection of customs duty through their corporate internet banking platform. This initiative enhances our role in facilitating seamless digital payments from government collection. Further, the bank has also integrated with Khazana 2 payment system, a comprehensive digital platform of the government of Karnataka. This system enables the state to manage all the financial transactions digitally, including revenue receipts and payments to employees, suppliers, and contractors. Through this integration, Bandhan Bank now becomes part of the unified e-payment gateway that ensures real-time transaction recording, secure processing, and online challan generation for various government dues. In addition, the bank is also integrated with the integrated financial management system in the states of Rajasthan, allows for efficient registration of bank accounts and real-time reporting of account balances to the respective government departments, further strengthening transparency and efficiency in public finance management. These initiatives reflect our continuous efforts to enhance digital capabilities, deepen relationships with government entities, and support the nation's digital transformation journey. On the collections front, we continue to focus on enhancing customer convenience and improving the repayment experience. During the quarter, we introduced unique QR codes for our EEB customers and integrated them with the BBPS ecosystem. In addition, we launched a web-based collection module enabling our customers to repay EMIs across products such as personal loans, auto loans, and two-wheeler loans with greater ease. With these initiatives, our customers now have multiple repayment options through the M-Bandhan app, retail internet banking, or via over 700 partner apps and web links. These steps significantly reduces friction, simplifies the repayment process, and enhances the overall customer experience. We believe these enhancements not only improve convenience for our customers, but also strengthen collections efficiency and contribute to the bank's broader focus on digital innovation and customer centricity. I now move to the performance of Bandhan Bank for the Q2 financial year 26 and the first half of financial year 26. I would like to candidly acknowledge that our Q2 FY26 performance were somewhat below than our internal expectations. However, the underlying trends and structural improvements give us confidence for an improving second half. There are a few factors that contributed to the softer Q2 FY26 performance outcome. Firstly, the 75 basis points repo cut impacted around 45% of our advances, and the 200 basis point reduction in NCLR affected another 5% of our loan book, which moderated the interest income growth during the quarter. We have partly offset this impact through reducing cost of savings accounts. However, the larger benefit from lower cost of term deposits will come through mainly from Q4 onwards. Secondly, slippages remain elevated, reflecting the ongoing stress in the EEB segment, which was anticipated to get corrected during the quarter, but seems that it will continue for 1-2 months more. Thirdly, growth in our EEB portfolio remains subdued as the full impact of the industry-level guardrails is taking longer time to materialize than anticipated. And finally, our advances growth came largely during the end of the quarter, mostly during the last month of the quarter, which made limited contribution to the profit and loss in Q2. While these factors moderated our near-term performance, we remain confident in the bank's underlying strength. The initiatives we have undertaken, including enhanced collection, strengthened risk management, and disciplined growth strategies, are already in motion. We expect these measures to translate into improved growth and profitability in the upcoming quarter. On a positive note, there are some encouraging developments during this quarter. Firstly, growth in our non-EEB book remains strong, reflecting the resilience and diversification of our loan portfolio. At the same time, the share of our secured assets continue to rise, which strengthens the overall quality of our advances. We are also seeing renewed momentum in CASA, which is a testament to our focused efforts in building a strong and stable deposit base. In parallel, our reliance on bulk deposits continues to decline, supporting a more granular and sustainable funding profile. From an operational perspective, our OPEX to asset ratio improved during the quarter, highlighting disciplined cost management. Importantly, in the EEB segment, SMA1 and SMA2 balances have declined sequentially, signaling early signs of improvement in asset quality that we expect to see reflected in the coming quarters. Finally, the bank's capital and liquidity position remains robust, providing a strong foundation to support future growth and strategic initiatives. Taken together, these developments give us confidence in the resilience, efficiency, and long-term growth potential of Bandhan Bank, and we remain optimistic about translating this strength into improved performance in the quarters ahead. While my colleague and Chief Financial Officer, Mr. Rajeev Mantri, will provide a comprehensive overview of the financials, I would like to take this opportunity to highlight a few key developments and performance indicators from the second quarter. As of September 30, 2025, our gross advances stood at about 1.40 lakh crore, reflecting a YOY growth of 7%. On the liability side, total deposits reached rupees 1.58 lakh crore, growing by a healthy 11% YOY and importantly outpacing the growth in advances. This clearly reflects our strategic emphasis on maintaining a healthy balance sheet that supports the sustainable growth. Our retail term deposits continue to show strong momentum, growing by 38% YOY. This growth reflects the increasing trust and engagement of our individual customers and the effectiveness of our distribution network. Our CASA deposits now account for 28% of the total deposit base, and the overall share of retail deposits, including CASA and retail term deposits, it improved to 71% compared to 68% in the previous quarter. This demonstrates a strong improvement in the granularity and stability of our deposit base, aligning well with our focus on building a sustainable and customer-driven franchise. We continue to execute our diversification strategy with steady progress. During the quarter, our secured book recorded a YOY growth of 25%, resulting in an improvement in the secured portfolio mix to 55% compared to 47% a year ago. Our NIM for Q2 financial year 26 stood at 5.8%, reflecting some pressure mainly due to the impact of the repo rate moderation. That said, margins continue to remain at a healthy level. For half year financial year 26, NIM was at 6.1%. Credit costs show a small improvement sequentially, and we remain committed to bringing them down further throughout the year. We also undertook technical write-offs of about rupees 855 crore during the quarter. Gross and net NPA ratios remain stable at 5% and 1.4% respectively, while our PCR, including technical write-offs, improved slightly to 87.6%. For quarter 2 financial 26, our net income stood at 3,135 crore, while operating profit was at rupees 1,310 crore. The bank reported a PAT of 112 crore for the quarter. For half year financial 26, ROA and ROE stood at 0.5% and 4% respectively. Our capital position remains strong, including Q2 FY26 profit. The capital adequacy ratio stands at 18.6% and Tier 1 capital at 17.8%, providing adequate headroom to support future growth. Our branch network expanded to 1,754 branches with the addition of 4 new branches during the quarter. As the microfinance environment moves towards stability, we remain confident in our ability to leverage the emerging opportunities ahead. Our focus will firmly remain on prudent risk management, disciplined execution, and identifying new avenues of growth while continuously enhancing operational efficiency to drive sustained performance. Before I conclude, I would like to reiterate that over the last year, we have articulated the Bandhan 2 strategy and have taken measures to achieve the same. We have taken steps to transition from a microfinance-focused bank to a full-service commercial bank. The focus of our transformation initiative has centered around a seamless integrated customer journey and a broad-based presence in various banking segments driven by technology and cost efficiency. Risk, compliance, and governance are the pillars on which we are moving ahead. These measures are being taken to achieve long-term value creation for our shareholders. However, during a transition, we may witness short-term pain, but I see green shoots and am confident that in the long run, we will achieve balanced profitable growth with a focus on enhancing shareholder value. With that, I would now like to invite our Chief Financial Officer, Mr. Rajeev Mantri, to take you through the detailed financial performance for the quarter. Thank you all.
Thank you, Partha sir, and I'll welcome again everyone to the earnings call. We will now move on to the business performance for the quarter. I'll walk you through the key financial highlights and provide an overview of how we have performed. We'll start with the advances. As of September 2025, the gross advances stood at rupees 1.4 lakh crore, reflecting a growth of 7% year-on-year, and on a sequential basis, the growth was healthy at 5%. Our emerging entrepreneur business or EEB portfolio stood at rupees 51,733 crore as of September 30, 2025, reflecting a decline of 13% year-on-year and 2% sequentially. However, if we adjust for the technical write-offs undertaken during the quarter, the portfolio would have remained broadly flat on a sequential basis. This is a result of steps taken to arrest the decline in EEB book while ensuring that the portfolio controls and guardrails continue to be implemented to manage elevated sectoral risks. With the operating environment showing some signs of recovery, we are expecting to see gradual growth in the EEB portfolio from Q3 onwards, supported by prudent lending, improvement in collections, and strengthened field discipline. Our non-EEB portfolio continues to deliver strong, broad-based growth. It now accounts for nearly 63% of total advances, up from 60% last quarter and 55% a year ago. The portfolio grew 24% year-on-year, driven by sustained momentum across both retail assets as well as wholesale banking. Retail assets grew by 66% year-on-year, led by secured products such as commercial vehicles and equipment loans, auto loans, and gold loans. Wholesale banking also performed very well, recording a 27% year-on-year increase, reflecting strong client engagement and execution. Overall, these results highlight the strength of our diversified growth strategy and continued expansion of our high-quality non-EEB franchise. Driven by focus on diversification and enhancing asset quality, we have further strengthened the secured loan portfolio driven by wholesale banking, housing, and retail. The secured loan book grew 25% year-on-year and now accounts for 55% of the total advances, reflecting the steady shift towards a more secure and balanced asset base. From a business mix perspective, our advances remain well diversified across the various segments. The EEB group lending accounted for 24% of total advances, SBAL stood at 13%, wholesale banking at 29%, housing at 24%, and retail assets at 9%. This balanced distribution highlights our conscious effort to reduce concentration and strengthen the portfolio stability and resilience. Moving to liabilities, as of September 30, 2025, our total deposits stood at rupees 1.58 lakh crore compared to rupees 1.43 lakh crore a year ago, reflecting a growth of 11% year-on-year. The deposit growth continues to outpace the expansion in our advances, underscoring our strategic focus on balance sheet resilience and stable funding base. We remain firmly focused on building a granular and stable deposit base with emphasis on growing our retail deposits. Our total retail deposits, comprising both CASA and retail term deposits, grew by 16% year-on-year. Within this, retail term deposits showed strong momentum, recording a robust growth of 38% year-on-year, reflecting the trust and confidence our customers continue to place in the bank. The proportion of bulk deposits to total deposits declined to around 29% from 32% a year ago. This downward trend reflects our focus on enhancing stability and granularity of our funding base. Our CASA deposits stood at rupees 44,211 crores, reflecting a 6.5% decline year-on-year. This was primarily due to savings interest rate reduction implemented in Q1, which led to some outflow from savings accounts and some shift towards retail term deposits. However, it has helped us in terms of reducing the cost of funds for savings as well. However, during the quarter, we have arrested the decline in savings balances and savings accounts grew sequentially by 3.2%. Overall, CASA is showing signs of recovery, registering a 5.6% sequential growth. Moving to collection and asset quality, the bank's overall collection efficiency, excluding NPAs, stood at 98.0% for Q2 FY26 compared to 97.9% in Q1 FY26. Within the EEB portfolio, collection efficiency for the month of September was at 97.5%. And for the full quarter of Q2, it was 97.8% compared to 97.6% for Q1 FY26. For additional information on collection efficiency, we have a detailed slide 19 in our investor deck. On the asset quality front, while headline metrics remain largely stable quarter-on-quarter, gross slippages at the overall bank level increased slightly to rupees 1,590 crores compared to rupees 1,553 crores in the previous quarter, primarily driven by the EEB segment. Slippages in the EEB portfolio were higher at rupees 1,118 crores during the quarter versus rupees 1,089 crores in the preceding quarter, reflecting ongoing stress in the segment. Recoveries and upgrades during the quarter stood at rupees 332 crores, marginally better versus rupees 319 crores recorded in Q1 FY26. This is at the overall bank level. While we observed some higher slippages in the EEB segment, there are signs of improvement in the SMA-1 and SMA-2 books. As of second quarter FY26, the SMA-1 book of EEB has improved to rupees 527 crores compared to rupees 532 crores in the previous quarter, and the SMA-2 book stands at rupees 388 crores versus rupees 484 crores in the last quarter. The increase, however, in the EEB SMA-0 book is largely due to the impact of raising installment demand on holidays. As we had mentioned earlier, when there is a holiday, we actually see some bit of an increase in the SMA-0 book, and therefore that we saw in this particular quarter as well. If we adjust for this increase in the holiday-related impact, we actually see a sequential improvement in the SMA-0 book as well for EEB. Out of the total EEB SMA-0 book of rupees 1,582 crores as of the end of Q2 FY26, as against rupees 1,009 crores in Q1 FY26, nearly rupees 650 crores of the increase occurred due to the holiday effect in late September on account of the festive season. And we have already recovered approximately 350 crores during October so far, out of this 650 crores. Additionally, the bank undertook technical write-off amounting to rupees 855 crores during the quarter, of which write-off in the EEB portfolio was rupees 799 crores. Consequently, the gross NPA and the net NPA ratio at the bank level were largely stable quarter-on-quarter at 5% and 1.4% respectively. Credit cost improved marginally and stands at 3.4% for Q2 versus 3.5% in Q1 FY26. The PCR, excluding write-offs, remains stable quarter-on-quarter at 73.7%. Turning to the quarterly profit loss statement, in Q2, our NII stood at rupees 2,589 crores, reflecting a year-on-year moderation of 12%. Our net interest margin for the quarter came in at 5.8% for Q2 compared to 6.4% in Q1 FY26. This movement was mainly on account of the full impact of 75 basis points repo rate reduction implemented in the current quarter, which had a bearing on our advance yields. In addition, the growing share of secured loans in our portfolio and some continued stress from elevated slippages also influenced the margin trajectory. We have taken proactive steps to mitigate this impact, including a calibrated reduction in the cost of our savings account rate. We expect to see further benefit from lower term deposit costs flowing through from the fourth quarter onwards, which should help support margin improvement going forward. Our non-interest income moderated by 10% year-on-year and 25% quarter-on-quarter, primarily due to lower treasury gains during the quarter. The last quarter, we actually had good treasury gains. We continue to make strong progress in diversifying our revenue base. Income from third-party products grew by a robust 48% year-on-year, underscoring the success of our cross-sell and customer engagement initiatives. Operating expenses for Q2 FY26 remained largely stable at rupees 1,825 crores, reflecting our continued focus on disciplined cost management. The OPEX to average assets ratio stood at 3.8% for the quarter, making a sequential improvement of 9 basis points. Operating profit for the quarter was rupees 1,310 crores. The bank reported a net profit of rupees 112 crores for the quarter as compared to rupees 937 crores in Q2 FY25 and rupees 372 crores in Q1 FY26. For the half year FY2026, we had NII and operating profit at 5,346 crores and 2,979 crores respectively. The net interest margin, operating expense to assets ratio, and credit costs were at 6.1%, 3.8%, and 3.4% respectively. The bank reported a net profit of rupees 484 crores in the first half of FY26 with an annualized ROA of 0.5% and ROE of 4%. Thank you for your time and listening to all our updates. On behalf of the entire management team, I would like to once again thank all the participants for joining us today. We appreciate your continued interest and support. With that, we will now open the floor for questions.
Thank you so much, sir. We'll now begin with the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use headset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Our first question comes from the line of Maruk Adajania from Nuvama. Please go ahead, sir.
Hello, good evening. So I had a couple of questions. Where do you expect the full year and the 2-year credit costs to settle? Right, and I understand that there were holidays, but even so, there's like a 54% increase in SMA 0, which is the sharpest. I know you explained, but even so. Where do you see the SMA 0 set? And you gave some October numbers, but where do you see the SMA 0 settling in the third quarter? And also, if you could highlight on the credit cost. That's my first question. My second question is that your PPOP margin, right, PPOP to assets has really fallen to a low in the second quarter. And it hardly there's very little margin now to cover the credit cost, right? So how do you strengthen the PPOP margin? Because the book will play out in terms of the change in mix and its impact on margin. So what are the levers we have to improve the PPOP margin to, take care of the volatility in credit cost? And my third question is that, in the Bihar election manifestos of opposition parties, debt waiver figures and a lot of softs to self-help groups are being talked about. So, how much of that would you expect to rub off to MFI in case these things come through in Bihar? So these are my questions. Yes.
So first of all, to answer your query on credit cost, so we have a guidance for the next 2-3 years where we have said that we should come to around 2.5%. So this is a transition phase, as we have already said. During this transition phase, the NPAs are going to rise, as you have seen that we have done some major accounting changes also. Definitely, for which SMA 0 is one of the conditions. We had some effect of the ballooning effects of the accounting system earlier, where the accounting, where actually the overdues were getting ballooned at the end of the EMI schedule, but now we are actually brought it forward. So that has resulted in some ballooning NPA, so which is the reason of the increasing credit cost, but it is coming down and it will gradually come down. This is the first thing. Second thing is that gross slippages of EV from the EV segment. So these are yet to get arrested. So till quarter 2, what was our expectation, it has not happened for definite reasons across the industry. And so that slippages are now showing some good trend, as what Rajiv has recently just said for the day, that the SMA 2 figures almost decreased by 100 crores on a month, quarter basis. And the trend is on the similar line. So we expect that substantial slippages can be arrested. So with the slippages, if get arrested, definitely the provision requirement will come down and the credit cost will improve. This is the first thing. So we are still maintaining our guidance that after 2-3 years, we will be putting at around 2.5 years. Yeah.
So just further supplement and clarify on the first point, what we have said is by FY27 exit is where we are expecting a credit cost of 2.5 to 3% for EV on a stable state basis. On an overall bank basis, we will be looking at a credit cost of 1.5 to 1.6%. And that is because we are improving our secured mix, as we've already seen. We will continue to endeavor towards that. And also we expect that the recovery in the EV environment comes through over the next 6 to 7 quarters.
So second part, your SMA 0, as you have already said, that if holidays are there, we can't help because demands are generated, but people are not there in the field for collection. So, but Rajiv has already given a trend that almost 85% of the amount of SMA 0 in the EV segment has already been recovered during the first month of this whenever it is due. We expect that this will also come down, but it will definitely depend on the holiday period. As regarding your PPOP margin, so the effect of the reduced cost of funds, that will come into a balance sheet almost on a large basis. A partial will come in Q3, but major will come in Q4, and Q1 of next quarter we will see a substantial impact of this cost of reduction of our interest rates, the moderation of interest rates, and definitely that will also improve our margin. Further, we are also taking steps to increase our other income. So recently we have also revised some of our service charges, and we are taking many more steps to increase our other income. The treasury operations, which has given us a huge profit in the Q1, obviously because of the increasing rates, it has not happened during this quarter. So we are also looking if we can gain some treasury, make some treasury gains. So these are the steps we are taking to improve our PPOP margin. And the fourth one is regarding Bihar elections. So we find that during election manifestos, many political parties do come with debt waiver. But we have also seen that most political parties have realized that this is not a permanent solution, and even the states do not have the capacity actually to fulfill this commitment. So we'll look into it, but I don't see a major problem because Bihar has been one of the good states compared to many other MFIs. At least for Bandhan Bank, the recovery has been quite good.
Yeah, and I think just to supplement the PPOP margin, because the full brunt of the repo rate impact came through in this quarter on the advances book, while we have taken actions to reduce the savings account rate, which has immediately given some benefits, the reduction in the term deposit rates will take a bit of time, depending on when the deposits come for renewal, and that's what we said from Q4 we should start to see. So effectively, this net interest margin will be sort of the lower point, and from this coming quarter onward, we should start to see some improvement in the net interest margins.
How much did you cut your MCLR by, say, since April?
So roughly 200 basis points.
But has anyone cut MCLR so sharply, or you are higher than peers?
No, we have just moderated the calculation. So earlier, what was the basis of the parameters of doing MCLR? Because we took this opportunity, we are one of the outliers. So we had an MCLR of almost 11.5 compared to the next one in the line in the queue with around 9.5 or 9.7. So we did a recalculation, and we thought that it should be prudent enough that we make the correction at one time because it may be a requirement going forward. So that has impacted almost 5,000 crores of our housing loans.
Okay. But as in change the way you calculate what in MCLR, like cost of funds is a given, na?
Yeah. So definitely, so some of the service charges which we are actually recovering from the customers, so that was the basis for that year. So that was, since we are recovering it, we are not taking it as a cost of funds.
I think some of the elements we just broadly aligned with the way the market actually computes it. So we aligned it to the market.
Okay. Thank you. Thanks a lot.
Thank you so much. Ladies and gentlemen, anyone who wishes to ask a question may press star and one on their touchtone telephone. The next question comes from the line of Abhishek Muraka from HSBC Bank. Please go ahead.
Yeah, hi, good evening, sir. So I have a follow-up question on the microfinance business. So in Bihar, has the MFIN stepped in, or have you or some of the large lenders, have you all made some representations or, at least issued some guidelines so that, your field agents, etc., can work without any hindrance? Or if customers tell them that, it's going to be waived, they have some official document to show saying that right now, you have to service your loans. So this, the reaction from the industry and the support that you might be getting or might not be getting from the government, if you can comment on that. So that's question one. I'll come back on question 2 actually.
So Bihar, again, I'm telling you that if you look at our portfolio, the delinquency trend is a very acceptable level, I can say positive. So almost 30 against with 30% if you look at the delinquency trend positive, the industry trend is 5.14 positive, and against which our trend is 3.82. If you look at the 90 plus delinquency trend, the industry trend is 3.0, ours is 2.04. If you look at 180 plus delinquency trend, 12.54 is the industry trend and ours is 6.84. So we are little bit comfortably placed than what the industry is doing for the day. And this election manifesto, each time, whenever it happens in any state, this one of the, I think many of the political parties do come up, but till now at least no major political parties we have not seen that they have come with this manifesto. But if you Vishal, if you want to add.
Yes, this is Vishal here. In terms of the Bihar, we are watching it very closely in terms of the impact in the last 1 month or so. In our portfolio as such, we have seen regular collections as being the way it's been happening in the previous quarter. Though we have taken the cognizance in terms of the noise that is going around in the political environment out there, because that's one of the things is always getting highlighted whenever a state election is happening. We are closely tracking it being performing as expectation, and in fact in the same manner it was performing in the previous quarter as well. So I don't think as of now we see a challenge, but we are cognizant of being keeping a very close eye in terms of how things are progressing there.
So some preemptive steps have still not been taken, or you've not felt the need to take?
No, preemptive steps have been already taken. No, we also
that's what I was asking about
with
actually. I understand your portfolio is good.
We also liaison with the MFIN body and the directives from there given to all the relationship officers to carry it along and to explain that these behavior, talk and all is all not sustainable and not rightful. And that is given to all of the ROs, which are the relationship officers who travel and make the in the weekly meetings, they make the customer very much understand whoever comes up with that query. We haven't seen thus far so much of customer noise saying that we waive our loan amount, or we will not like to pay because people who are saying we're going to pay on behalf of us. Those things have really not come up. There have been very small 1 or 2 group meetings in which it has come up, and we will explain. We haven't seen much of a number difference of collection.
In fact, much better than the industry.
So even the MFIN has given us, one pager to, inform all our customers in terms of during the election time, and not only specific to Bihar. Whenever state elections are there, the MFIN has been a common guideline given to all of us in terms of how do we, explain to the customers who are raising this point of, political interferences and waivers for the loan.
Understood. Okay, thank you for that. The second question is, as your disbursements in EAD have gone up, and obviously in a couple of states there is still an increase in SMA 1, 2, etc. And you've also said in your opening remark that stress may continue in EEB for 1 or 2 quarters. So which geography have you been comfortable in lending? That is what I wanted to understand. Where has this disbursement happened?
Abhishek, just to clarify what MD sir mentioned was just to probably continue for 1 or 2 more months, and thereafter we should continue the recovery. Just to clarify.
Yeah. Sure. Okay. But the question still stands. So where have you found comfort in increasing your disbursements and lending more?
So definitely I can say the eastern part is doing reasonably well. So West Bengal, Assam, Bihar, all big states. In the other parts also we are seeing delinquencies are improving. The collection efficiency has improved. But see, like rightfully MD sir spoke about, West Bengal, Bihar, Assam continues to be our strength areas, and that is where we have seen growth also coming in. We have a large existing base. So that is a renewal every 12 months or 18 months. So that is where we really, for the good customers of ours, we really focus upon and try to get that reviewed. So West Bengal, Assam, Bihar is that order keeps on going well. We've also seen some traction happening now in parts of Odisha and Madhya Pradesh, though not in that scale of what Eastern India is going on. The places where we are really not able to go because of the guardrails are Tamil Nadu and Karnataka because of the late entrance of ours. Otherwise, we see decent renewals coming in, and you would have seen by the numbers, disbursal of EAB in last quarter 2 versus quarter 1, has been almost back to the levels of FY25 quarter 2 levels.
is almost there.
One good trend.
So that's one confident statement, which we get in when we see that the disbursements are picking up, because the business runs both ways. Disbursal and collection goes hand in hand.
So this quarter, I think we have made more than 5,000 crores.
September month we crossed 5,000 crores of disbursal on the month of September.
Understood. Okay. All right. Thank you, sir. Thank you for the clarification and all the best.
Thank you.
Thank you so much. Our next question comes from the line of Arvind Ravichandran from Sundaram Alternates. Please go ahead.
Hello, team. Thank you so much for the opportunity. I just wanted to understand, in housing category also, NPA percentage moved up sequentially.
I think,
NPA percentage.
can you be a little clear?
Sorry, Arvind, the line is not very clear. Yeah.
Sorry, can you hear me now? Is it better now?
No. Not better. There is some, I think, associated echo is coming.
Hello, is it better now? Sorry.
Yeah, I think it's clearer.
Yeah. Sorry. I was trying to understand, in the housing category also, sequentially NPA has moved up NPA percentage. Is it again because of the holidays, or is there something else in the play here? Because growth is also very strong there in housing category, despite that NPA percentage moved up sequentially. I could just understand what is.
Yeah. So I think if I could understand, sorry, the audio is still in and out. So your question is around the housing NPA and the SMA, right? As to what exactly is driving that?
Yeah, housing NPA sequentially moved up despite being higher growth, having higher growth. Just would like to understand what is happening there.
Sure. So I think like MD sir had mentioned earlier, there had been some sort of ballooning related NPA recognition which had happened some time back, and we do an assessment of that on a quarterly basis, so which affects some bit of the housing. However, even if the SMA book has slightly gone up, and we've seen that the credit cost and the final recoveries that come through are commensurate, and therefore the net credit cost that comes through is aligned to the industry standards. The little bit of an increase that we see coming through the housing pertains to some of the underlying portfolio in the affordable segment, but the bank is taking efforts to make sure that the recovery comes through within that. So we are not seeing any kind of a material trend per se, which is causing a significant risk. But there are basically certain areas and certain sectors or sections within the housing where we are seeing the risk emanating a little bit more. But the bank is taking the actions to make sure that the collection efforts increase on that particular front. But overall, on a net basis, even after the recovery, if you look at the credit cost, is actually quite commensurate with what we see in the industry.
So slippages has gone to 2.4%. So that is in the housing loan segment. But at the same time, recovery is around 15%. So the NPA to the total advances stands at 2.8% during the quarter. Slippages was 2.3, not 2.4. So 2.3.
Okay. And just one more question. Within the EED portfolio, Bandhan plus more than 3 lenders, it has been actually stable for past few quarters. Is it what is happening there? Are you finding it difficult to run down that portfolio? What is happening there?
So see, we put the guardrails on April 2nd for FY2026. That means it's been 6 months since the time the guardrail has been put into effect for 3 lender norms. I think we'll have to wait for 2 more quarters, and gradually it will speed up. Because as of now, you have to compare in the first 2 quarters, the 3 lender plus has gone down by 50 basis or 100 basis. 1% it has come down. From 11% to a 9.5%, right? So this 9.5% now will go at a speeder pace from quarter 3, quarter 4 onwards. So come March, because our loans also run for 12, 18, 24 months. So come March 26, you will see this number of 9.5 going down to a 7-6% is what when we checked out, it will become that way, and below 5 maybe quarter 1 FY2027.
Yeah, actually that's typically taken at the stage of renewal.
Yeah. So but what we are seeing, obviously, 100 basis come down already in the last 2 quarters. And you'll see the traction really picking up now because whatever has been booked for last 18 months, it will start maturing now in 12 months and so on and so forth. So the numbers will of Sri Lanka now will speeden up compared to what it has been happening. The numbers will keep on going down from there.
Understood, sir. Understood. Just one last question. So,
I'm so sorry,
branches
sir.
addition.
Arvind, sir, I'm sorry to interrupt, but please rejoin the queue for the more question. Thank you.
Okay. Thank you. Thank you.
Thank you, sir.
Thank you.
Ladies and gentlemen, in order to ensure that the management will be able to address questions from all the participants and the conference, kindly limit the question to 2 questions per participant. Should you have a follow-up question, please rejoin the queue. Our next question comes from the line of Anish Rai from UBS. Please go ahead.
Hello. Yeah, hi. Thanks for taking my question. So I have a question around your net new EEB customer acquisition. So that has been hovering at the same level for quite a while now. I think for last 2-3 years now. So just wanted to check, do you still believe there's an increasing penetration story there? Or I think you think the market there has sort of saturated, now it's all going to market share gains? Because the related question is, so when you think about growth for the microfinance industry or for the bank, where do you see that growth coming from? Because I think anyways, leverage and all would be quite conservative from here on. So how do you see that growth without that increase in customer acquisition? Yeah, so that is my question. Thank you.
Sorry, Anish, your question, just to understand, is the increase in customers or increase in advances?
No, net EV customers, active customers. You disclose net EV active customer number, right?
Got it.
So you're right that we are stagnated in terms of the new borrowers coming in month on month. But as we speak, even today we keep on adding up 1,30,000, 1,40,000 customers. On an average in a quarter we add up 3.5, 4 lakh customers. What we also realize when we go for new customers, there are a lot of rejects which have increased in the industry due to delinquency, and that's why we are also not able to really work upon in terms of getting the new borrowers because they have been rejected on account of the performance outside Bandhan Bank as well. And that's the industry trend. The good news is that on the renewal side, we have been working very closely with analytics to ensure that the pool of customers of ours, which have been with us for a longer time, are all getting renewed and are all getting rolled for the new loans as well. So this traction we will keep on seeing for the next 1 or 2 quarters. And once the industry stabilizes and the leverage issue is completely licked off, we will try and get further new customers. Currently, if you see and go by the industry number, around about 23-24% of the overall industry customers are ineligible to take loans going by the government.
Okay.
I hope I'm able to answer the question.
Yes, sure. Thank you.
Thank you, sir.
Thank you.
Our next question comes from the line of Param Subramanian from Investec. Please go ahead, sir.
Yeah, hi. Good evening. Thanks for taking my question. Firstly, on funding cost. So quarter-on-quarter, your cost of funds is, there is not much movement. Why is that the case? Because your CASA ratio is up. We have taken substantial cuts in our savings rate as well. So why is cost of funds not yet showing improvement? And related to that, how to think about NIMs going into second half and next year? Because I think at the beginning we had, of the cycle, we had called out that because of the mix shift, the bank would lose 70-80 basis points of NIM. And it looks like we're already there. So how to think about NIMs from here on? Yeah.
So the funding cost, what we have already explained, that a moderation in the savings bank has come. So my funding cost of savings bank has almost like 200 basis points has come down. But the fixed deposits are yet to come. So we have got almost close to almost 70,000 crores of retail term deposits and also fixed bulk deposits are also there. So there's the moderation will take place as and when these get renewed. So it will take actually to.
Your CASA ratio is up, right, quarter-on-quarter, and there is a savings.
Quarter-on-quarter it is marginally up. Yes, we are 28%. It has
from 27.1 to
27 to 28%. We are marginally up. But the main thing is that because of the fixed deposits which were carrying a very high rate of interest. So that needs to get moderated, and that will get moderated only at the time of renewal, for which we need to wait till quarter four. A little bit impact will come in Q3, but not much. So Q4, actually the major impact will come.
Just to share some numbers, for instance, for our savings account, the cost has come down from an average of 5.52% last year, or even in March 25, 5.5% to almost 4.2% for this quarter. And in fact, September month was almost down to 4%. So we have done substantial reduction in savings cost, which will continue to give us benefit going forward as well. The term deposit rate reduction that we have done will take some time to effect because of the renewal date of the TDs coming in largely in Q4. Some will come in Q3, mostly in Q4, some will come in the first half of next year.
And the second question regarding the NIM, so we have already indicated that as we are moving towards more secured books, the NIM would get impacted. It has got further impacted because of the upfronting of the repo cut, which we were not expecting. But again, the moderation definitely will continue. So, but our guidance is that we should have it around 6%. So we are working towards this. It is not that EB will not grow. So whatever the degrowth in the EB has taken place, I think it will be arrested, and from Q3 onwards, we will be witnessing the growth. So that will definitely help us in actually achieving our NIM target. So currently we are around 6.1 if we look at the half year. So already another 10 basis point moderation we have already taken into account, and probably with the EV segment going up, we will be able to achieve.
Yeah, and I think just to supplement this, the NIMs for the quarter were 5.8%, and what we expect as the renewals for the TDs come through, the margin should improve from these levels. So we actually expect an upward trajectory from here, and this could be sort of the bottom point, at least during this financial year.
Okay. So from here on, it improves. And even from a mix perspective, right? So our strategy, we had initially highlighted that we want secured, in the loan mix of about 55%. I think we are broadly there. Even microfinance, including the individual loan, is 36-37%. We seem to be already there, right? So how to think about mix going forward for the next, going into FY27? Is microfinance going to grow from here, and has it bottomed out in the mix?
So that is our strategy. So if we grow in microfinance, our growth in the non-microfinance will be much more, at a much higher rate. So this ratio will be maintained, or a little bit it will dip down.
Yeah, so I think the secured mix could actually increase further by another, say, 2-3 percentage points through the next 6 to 7 quarters. But the degrowth in the EEB book is what we're trying to arrest, so that we can at least start having a moderate bit of a growth. That is why we are trying to get the mix.
Okay, so 55 can move towards something like 52 or broadly, right? Is what you're saying? 2-3%.
No, what we are saying is 55 to go down further to say 57-58% over the next 7 quarters. But during that particular period, we will also try and get the growth back into EB. So the ratio could move between ranges effectively.
Okay, fair enough. And
I'm sorry to interrupt you. I'm really sorry to interrupt you, Mr. Subramaniam. You can rejoin the queue for the next question. Thank you.
Okay.
Our next question comes from the line of Anand Dama from Emkay Global Financial Services Limited. Please go ahead, sir.
Sir, thank you for the opportunity. So this MCLR cut that we have done 200 basis points, is that something to do with RBI telling us, or is it basically we have done it on volatility?
Let me make it very clear that it has got nothing to do with RBI.
Okay. And is there anything, so basically I'm sure that this year's RBI supervision would be largely over. Any adverse comments that basically came through in the RBI report?
I think that we cannot pinpoint it. That all banks do have the report. So, but I would say that the major regulatory issues which were there, those have been already, I think, have been addressed. And where technology dependence is there, these are on the process of getting addressed. So that much I can say. So the major regulatory issues what were there, we have already addressed those things. But definitely, whenever you are in any banking operations, there will be some observations from the regulator. We will address as and when required.
Just to confirm, basically, we will not have any further shocks in terms of any PSLD classification or anything that would come from RBI.
No, nothing as such we have received in the supervisory.
Sure. So secondly, on Bihar, I think it's the opposition manifesto which has talked about some kind of waivers and so on. The ruling party hasn't. But is there any difficulty in terms of approaching the customer in terms of collections now, given that the elections are around, or we are able to reach to the customer, we conduct center meetings and so on?
Can I answer this question before I just quickly repeat in one sentence? As of now, we are cognizant of the issues raised by the opposition. However, we haven't seen any material change in our collections as per today as well, till date. But we are keeping a close watch, and it's been a part of the business of ours now. Whenever there's a state election, these things are being spoken about, and slowly it settles down and stabilizes. So we haven't seen any disruption as of now. So customer visits are happening, group center meetings are happening in the normal.
Sure, sir. That's very helpful, sir. Thanks a lot.
Thank you.
Thank you, sir. Our next question comes from the line of Hardik Shah from ICICI Securities. Please go ahead.
Yeah, hi, sir. Good evening. Sir, if you can quantify the MFI slippages in this quarter.
Just a minute. Sure. Just give us a moment.
And sir, any qualitative reason why, the situation did not pan out the way it should have been? Because other banks, all banks which have MFI segment, they have seen 20, 30, 40% decline in slippages. So what is this a geographical thing which is a bit of an adverse thing for us, or why is it that the slippages seems to be elevated or not improved significantly versus others?
So maybe I'll answer both. So firstly, on the number, the slippages for the EEB, which is group loans as well, both, was 1,118 crores. This was the gross slippage, and the net slippage was 984 crores. The gross slippage increased marginally from 1089 to 1118 during the quarter. On your second question, I think, from our perspective, the bank had already been following the guardrails to a large extent, right? If you look at it, for us, the Bandhan Plus 2 portfolio was almost close to 90%, and the over-leveraging portfolio portion of the EEB was only around 10%. That also has improved further down to 9.5%. However, the industry number used to be much larger, and what we see from the bureau report, the industry almost a year back was 19%, and over the period they have tried to come down. So you will probably see the reduction more in the industry because they are coming from a position of a much higher delinquencies to a lower delinquency. From our standpoint, our delinquency levels are lower, and we have been doing better than the industry. However, at the same time, we are trying to put in efforts to make sure that our collection rate recovery efforts go up, and also that we have lower slippages come through, which is what we are expecting sometime in Q3 onwards, the recovery to come through.
Quickly, as a supplement in terms of what we spoke about the industry, I'll give you the figures, which is reported by the Bureau end of September. 180 plus delinquency, which is typically at an industry level, is at 15.26. We are at 7% at a 180 level. At a 90 to 180, industry is at 3.27. We are at 2.08. So comparatively, both 90 plus and 180 plus, we are far superior compared to the industry. So even if they have said slippages have reduced, maybe for this quarter, they have already been at a very high end of 180 and 90 already in the previous quarter. The current quarter, if I stand in point, if I see in the month of September, there's a large difference between both 90 plus and 180 plus. So I'm not sure about where are we getting these figures of slippages of the industry overall improving. But when you get some other banks, so they have a very small amount of this EV book. So there maybe they must have percentage-wise have shown a better improvement compared to us because we have a large base. So on this large base, the percentage improvement is difficult to predict.
Okay. Sure. And secondly, sir, this 650 crores of SMA 0, which was because of bunched up holidays, that you have managed to recover 350 of them. Ideally, it should have been, even much more, right? I mean, is that the understanding, or this 650 crores of bunched up holiday, Of course, the holiday season is over, and then 2H for October should be a decent active month. You have only managed to recover 350. Is that what? I mean, this is what you said, right? That you have managed to recover 350. You have managed to regularize 350 crores out of 650 bunched up, right?
Let me explain this holiday demand for your understanding. What happened was, because we have got a predominantly 53% of our portfolio in East, and September 29th and 30th for holidays, there is an impact of holiday demand in which we collected 92% of our customers. 92% of the customers on the days of 29th and 30th, we were able to collect. 8% of the customers, which was because we have weekly installments, we were not able to collect. And the following week, we are able to collect 95% of the 8% of the customers. But what happens is, because of the 8% of the customers, that totals up to close to 600 odd crores of the principal outstanding, which moves to 1 DPD, 1 to 7 DPD or 7 to 15 DPD. There are 2 Monday holidays. Like in this month of October, there have been 3 holidays on Monday. Because of being a Monday weekly installment, but we have to take advance. We take 92, 93%, 7, 8% are flown to the next weekly cycle, and this we collect again in the next weekly cycle. So whatever flows, like this 550 crores, which had happened earlier as well in the month of March 31st and specifically on the last day of the month, we are able to collect 92, 93% in the advance, 7, 8% in the following week. And that is a proof of the testament that when you see SMA 1 and 2, there is no increment there, even from April to September, October. But SMA 0 gets elevated temporarily for a week primarily, and slowly it keeps on coming down week by week. So as I speak, this 1500 number which is reported here as an SMA 0 is the 1200 odd number, and 3-4 days back. So this number will slowly come down to a below 1000 number, which was there in quarter 2 and so on and so forth in the next 1 month. Because there are no more holidays in November and December, and nothing coming at the end of the month. The last day of the holiday month, of a holiday in the last day of the month becomes a bigger problem because you don't have time to collect for that particular month. And September 29th, 30th, first and second were holidays. So there were continuous holidays released for that day. But like what Ravi explained, bulk of it is already got collected in October, and whatever is still that 1 week pending will further get collected in November. So I don't see a risk in SMA 0 formation. The risk is very temporary for 2 to 3 weeks and that is stabilized. This particular month, because of 3 Monday holidays, it is taking maybe 1 week or 2 weeks more. From November, and I think that PAR 1 to 30 will stabilize back to the normal number of June quarter. I hope I made everybody clear on this point. So it's a temporary blip because of the last day being a holiday month.
Yeah, thanks, Vishal. And sir, just the last thing on your notes, in the EPT you mentioned that GMP wholesale has come from 8.
We can't hear you.
Sorry, Hardik, your audio is not very clear.
Yes, sir. Sir, is this better now? Okay, sir.
The voice is
wholesale ABG
cracking. Voice is cracking.
Some problem today.
Can you come closer to the mic?
Sure, sir. Sir, I wanted to say.
No, I think still some audio issues there.
Okay. Sir, I just wanted to check this wholesale banking ABG book and erstwhile SEL book. What is the reason for the rise in GNPA there?
Yes, thank you. We're talking about the erstwhile SEL, which is ABG book, the increase in NPA. Is that the question? Yes, hello.
What is the reason?
SEL increase in NPA.
Okay. See, this SEL erstwhile book, the denominator impact is there. We have gone a little slow in terms of the growth in SEL, and we are planning to change our policies and making it far more robust. For that reason, there is an impact of denominator growth in SEL. Otherwise, the slippage pattern of ABG has been on the similar numbers month on month, the way it was there also in the previous quarters or so. But because of the denominator coming down in the growth, we are trying to make it in a more robust manner. That is why you will see that impact of the NPA elevated and the percentage is going higher. So in terms of the number as per se as such, it is pretty much in the same trend.
Sir, I was referring to absolute number only. 730 crores of GNPA has become 870 crores on a quarter-to-quarter basis on wholesale banking. And
So wholesale
The
banking.
GNPA in wholesale banking, 730 crores has become 870 crores.
Yeah, the wholesale banking book includes the ABG portfolio. I think if you look at the wholesale banking NPA levels, excluding the ABG, it is quite low, almost like 0.5 or 0.6%, 0.8%. But ABG is what has a slightly higher NPA, primarily because the book actually has been degrowing, and the denominator effect, like Vishal mentioned, is affecting the NPA percentage. But there are certain underlying risks which the team is actually looking at in terms of improving the collection. It has been an unsecured portfolio, which actually has had some bit of a NPA level, but the team is focused in terms of making sure that the collections come through within that.
Okay. So this is unsecured business banking, right? I mean, what we see at other banks,
That is
business
correct.
banking. Okay.
That is correct.
And this is not a LAP, right? This is business banking unsecured working.
No. This is not a LAP.
loan.
Not a LAP. Not a LAP.
It is unsecured.
Thank you, sir.
Thank you. The next question comes from the line of Vatsal Paraksha from Knightstone Capital Management. Please go ahead.
Yeah, hi. Thanks for taking my question. My question is regarding MFI. We are seeing that Madhya Pradesh and Bihar and Maharashtra also have some difficulty in collections from some other players. Are you seeing any stress there?
So like I said, Bihar is doing reasonably well for us. For us, like I said, Tamil Nadu, Karnataka is a little stressed. Maharashtra is doing reasonably okay for us as far as we are concerned, though I see there is an industry difference from our portfolio compared to the industry portfolio. Industry doesn't do that well. For us, Gujarat is a little, compared to the industry, a little cause of concern, but not that much to worry because our portfolio in Gujarat and southern states are much lower if I have to compare. And so we are keeping ourselves abreast in terms of and watching the Gujarat portfolio more qualitatively. Maharashtra is still holding for us the way it was earlier.
I hope the question was answered. I think operator could
Hello.
Yeah, Vatsal, could you hear that? The answer?
Give me 1 minute, sir. Vatsal, please go ahead.
Yeah. My next question was more forward-looking in nature. For H2, we were banking on the growth being higher in MFI and the asset quality improving. But next year in Q4, West Bengal and Assam both will have the elections. Just wanted to understand historically in the past 2-3 election cycles for West Bengal and Assam, what has been the trend in disbursement in asset quality? Like, do they significantly deteriorate or we can bank on H2 being significantly better than H1 despite the election months being there?
In fact, 5 years back when the election took place, the portfolio quality was much better. There were no issues at all for in West Bengal. There is I think no election, no political company, political party gives a campaign that loan waivers are. So this is.
I don't think that's going to happen in any way. But Assam also there was post-election this had come up earlier. But I don't think in Bengal specifically anything of this is being even spoken at this point of time. But like I said, this business is such that there is a political infringement and we are aware of how to manage it even now because we have been doing it for a long time across the industry. And this business is also microfinance has been half two is far superior than half one in terms of both disbursement growth and stability in terms of quality of the book as well. So we are optimistic that quarter 3, quarter 4 will have better trends in terms of both growth as well as in quality of the asset book.
And also, I think because of the various guardrails and the communication, the borrowers are also well aware now of the need for a discipline in terms of repayments.
Absolutely.
Okay, got it. And lastly, have you taken any price hikes in group loan?
No. We have not increased any price.
Okay, got it. Yeah, that's all. Thank you.
Thank you, sir. The next question comes from the line of Aravind Ravichandran from Sundaram Alternates. Please go ahead.
Can you hear me? Yeah.
Yeah. So again, sorry, to again ask this question, because we have seen different players, because of the risk-based pricing in MFI, they have inched up the yields, 25 basis points, 100 basis points, different lenders have done different things. But based on the past several quarters, they felt like there is a need to rise the yields. Don't you see any need like that in rising yields for JLG loans, MFI loans? That is my first question.
We are not looking at moving any risk-based pricing because the group concept is cohesive. So it's difficult to implement risk-based pricing in a group in many ways. So we want to continue the way it is in terms of ensuring that we get the right quality book rather than looking at a risk-based pricing, because the group concept is very cohesive when we form a group. And it is very difficult to implement on the ground to give different risk-based pricing and explain in a particular group. And so we have been keeping the way in terms of keeping a flat rate at a group level. And we haven't increased the prices or yields in the recent past.
Yeah, I think there is no plan to hike the rates in the MFI. Rural market basically is a very sensitive market. So because one customer is getting a particular rate, another is getting another rate, then there is basically a disconnect. So most of them want the similar rate. If they have taken a loan of 50,000 rupees, in the fixed installment, I am paying so much amount to that to be done.
So if you look at the risk profile of this customer, the risk profile is also the same. It is very similar, excepting that some are paying on time and some are paying with some delay or some are not paying for the day. But if you look at the risk profile for anything, whether on the basis of income or whether the basis of the sleeves, the unstructured information, the risk profile almost is very similar in respect of this particular segment of customers.
Just one more question on branch addition. Branch addition has been, I think, lesser than our desire, I guess, in terms of linking back growth for the subsequent quarters, for let's say even 27 or 28 also. How are we looking at it now?
Sorry. We are unable to understand the question.
Sorry. I was trying to understand, branch addition has been, particularly slow in the last few quarters. Yeah. So, if we want to get back the growth in the subsequent years, is this enough? Are we going to significantly accelerate the branch expansion rather investments there? I understand that you mentioned that we need to make investments. Yeah.
Yeah. So we have already a plan for branch expansion during the next 1 year. So we are just going ahead with that plan only, but our motto is not that we would go very aggressively in branch expansion. Rather, we are focusing on the digital strength capability of the bank. But definitely in geographies where our presence is very less. So we are focusing now on the south. We are also focusing a little bit on the north, but definitely much lesser focus on the east.
Understood.
Thank you.
Thank you, sir. This question comes from the line of Maru Gadajania from Novama. Please go ahead.
Yeah, thank you for giving me one more chance at asking questions. I just had one clarification that ECL will be implemented now. So what would be your overall SMA pool? Because that will determine the stage 2 provisions, right? In terms of even other loans. So obviously you've been transparent enough and you are disclosing the EEB pool regularly, which is very helpful. But what is the total SMA pool including non-EEB? like say for 0, 1 and 2?
Yeah. So, Baruk, we have sort of looked at the new regulation.
September 30th or what?
Sorry?
You want the figures as of September 30th or you are wanting
Yes.
what will be the
September
future?
30. No, September 30. The total SMA.
No, are you asking for the SMA as per the current books or SMA as per the India's new guidelines?
You can give either. I mean, you can give both.
No. So look, we are assessing and evaluating. I think our draft guidelines have come through. We are looking at what exactly it would mean for the bank. I think at this stage, that process is still on. So currently, I think whatever we have in terms of the BPT books, in terms of SMA 1, 2, etc., we have already included in the investor deck for ED. So I think you will be able to see the details there. But the assessment for the new guidelines of ECL is still under process, so we will not be able to have the details of that.
Sure, but in gap, would you be able to share the total SMA pool under in gap, including non-ED?
Sorry, Bharat, we will not have the figures for India right now, not for ECL.
Okay.
So as per the new guidelines.
In gap also you won't have?
Yeah, we can share it later. We can engage subsequently and then have a conversation.
All right. Thank you so much. Thanks.
Yeah. We'll connect with you, sir.
Thank you.
Thank you, ma'am. In the interest of the time, that was the last question. I now hand the conference over to the management for the closing comments. Thank you.
So thank you everyone for joining for the investor call and for patiently listening to the various updates as well as for asking the various questions. And thank you for reposing the trust in the bank. Thank you so much.
Thank you, sir. On behalf of Bandhan Bank, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe to Concall India for latest upcoming Concall.